So now let's continue our discussion about capital structures in a perfect capital market. And let's further explore what this ultimately means. Now, Modigliani and Miller, again, apply this concept of the law of one price. Essentially, the analysis says that leverage will not affect the total value of the firm. All it does is changes the allocation of cash flows between debt and equity. So cash flows of the company don't change, just who receives them. So let's at least define a little bit better what perfect capital markets means first. First of all, companies can trade the same set of securities at competitive prices. There's no taxes, transactions, costs. Financing decisions do not change the cash flows of the company, nor do they reveal any new information. So essentially what we're doing, we're eliminating all the things that could possibly affect the company with the except for one question. What happens when the company changes the cost or the amount of debt relative to equity in their financing mix? So Proposition 1 for Modigliani-Miller talks about this concept of value. The total value of a company equals the market value of its cash flows. It's not affected by the choice of capital structure. So in the absence of taxes, again, the total cash paid out is equal to the total cash flow generated. So again, we keep repeating this idea now that the value of the company's securities is exactly equal to the value of its assets. In perfect capital markets, we've discussed this in some earlier videos, securities are fairly priced. So that means the buying and selling of securities has a net present value of zero. All payments to investors are exactly the same. There's no net gain or loss from the issuance of debt, and there's no change in value. Now remember, we're talking about this world essentially in its fundamental definition or state, I guess. This is a world with zero taxes. Think about that world and whether or not a world with zero taxes would care or be influenced by borrowing money and having interest expense if there's no tax consequence. To further illustrate the reasoning behind this, or to further bolster our argument, I guess, we can talk about a concept called homemade leverage. It says if the company isn't financing the way you would like them to finance, that is, if you don't agree with the financial strategy, you can create your own financial strategy outside the company. And what we'll find is that if the shareholder can create their own equity, they don't care whether, or their own leverage, they don't care whether the company creates it or them, right? The value that they receive is identical. So here we have a company where we have a margin loan. So we borrowed $500,000 and we used that money to buy into this levered equity company. So what we find here is that the cash flows in the end are the same. An unlevered company, this is what we bought into, right? We bought into this company. So these are the cash flows we receive from our unlevered equity. But because we did a short sale, we borrowed, we're going to have to pay back this 500. That's our levered equity position. And here our cash flows are the same. So again, with homemade leverage, what we find out is nothing has changed, right? Your choice of capital structure doesn't affect the opportunities that are available to investors. In fact, they don't affect the opportunities that are available to the company. So investors can alter their leverage choice on their own. And with perfect capital markets, since there's no benefit to investors or not, there won't be any influence on the value of the company. So let's briefly kind of talk about a concept that we've mentioned, which is the market value of the balance sheet. This is a balance sheet where all assets and liabilities have a price tag. All of their values are current market values rather than their historic costs. The total value of all the securities issued by the firm are equal to the total value of the firm's assets. So if we look at a short balance sheet here, we can see that how this kind of lines up. I guess one of the questions I had, and this just pose a thought question, is if I can actually find and identify the tangible, what these things are worth, I know what these are worth, I know what the total market value of the firm's worth, can I then just by a little algebra determine the value of my intangible assets? And for companies, some companies, this may ultimately boil down to maybe just human capital. You know, what are the employees of the company worth? Well, if you know the market value of its tangible assets and the market value of securities, it's just the remaining balance. Again, that's just a thought that I had. But the point they're trying to make with this brief little couple of slides here is that the market value of equity equals the market value of assets minus the market value of debt and other liabilities. So value, the value of the equity of the company is created by the purchase of profitable assets and investments. And if you kind of ask yourself, right, where does the company make money, right? Where is cash flow generated? Cash flow is generated by plant and equipment, by the employees of the company. It's not created, cash flows are not created on the right-hand side of the balance sheet. It's not created on the right-hand side of the balance sheet where the financing occurs. So let's take a real quick little example here. Let's talk about something called leveraged capitalization. So what we're going to do is we're going to borrow money, and we're either going to pay a special dividend, or we're going to repurchase a significant number of stocks. So how is this going to affect the company? So here we have a company, they're currently all equity, all right? They have 50 million shares, it's trading at $4 a share. They're going to increase leverage by borrowing 80 million, and they're going to repurchase 20 million of its outstanding shares. So the importance of this illustration is to show this is the company before, here's the company after they borrow. If you notice, both sides of the financial equation increased. And again, if you calculate, we haven't bought the shares yet, we're still going to have a value of $4. And after we buy back the shares, now we've come back to the original company where they both have $200 worth of value, but now we only have 30 million outstanding shares. So again, if you divide the $120 now of equity, divide that by the 30 million in shares, we still have $4 in value per share. So essentially what this is saying is, it's just an example of how changing the financing in a world with no taxes, in a world with a perfect capital market, this world will not change the value of the firm with inside it.